Welcome to the Explainer. Today, we're going to crack the code on credit card interest. We're going to get into how it really works, why it can grow so darn fast, and most importantly, how you can get the upper hand. So let's kick things off with a question. Have you ever had that feeling, you pay your credit card bill, you feel pretty good about it, and then the next statement comes and the balance has barely budged? It is so frustrating, right? Well, today we're going to figure out exactly why that happens. Okay, so here's how we're going to break it all down. We'll start with what I call the interest snowball. Then we'll decode your statement, get into the rules of payment, talk about using those 0% APR offers wisely, and wrap it all up with your very own payoff playbook. All right, first up, the interest snowball. This is really the key to understanding how a small balance can suddenly feel like it's growing exponentially, just getting bigger and bigger. So what's the secret sauce behind this snowball effect? It's a little thing called compound interest. And here's the kicker. It means you're not just paying interest on what you borrowed, you're paying interest on top of the interest that's already been added. It's a cycle that can make debt grow incredibly fast. A lot of us think interest is just a monthly thing, but it's actually happening every single day. Here's how it works. The bank takes your APR, that big annual percentage rate, and they chop it up by 365. That gives them a tiny daily rate. And then every day they apply that rate to your balance. The interest gets added on. And guess what? The next day they do it all over again, but on that new, slightly higher balance. It's a daily drip, drip, drip that really adds up over a month. Okay, so now that we know interest is being calculated daily, how does that translate to the number you actually see on your bill? Let's decode your statement and get into the nitty-gritty of the math they're using. Pretty much every credit card company uses something called the average daily balance method. And what this means is, they're not just looking at your balance on the last day of the month. Nope, they're actually looking at your balance on day 1, day 2, day 3, all the way through the cycle, and then they take the average of all of it. So check out this simple example. For the first 10 days, the balance is $1,000. Then you make a $100 purchase, so for the next 20 days, it's $1,100. The card issuer adds all of that up and divides by 30 to get your average daily balance. And that's the number they charge interest on. See, this is why every little purchase and every payment you make during the month really matters. Okay, this next one is huge. Let's talk about the grace period. You know that magical time where you don't pay interest on new purchases? Well, here's the catch. That grace period only exists if you paid your last bill in full. If you carry over even a single dollar of debt from the previous month, poof, the grace period is gone. And that means every new thing you buy starts racking up interest from the moment you swipe the card. And speaking of sneaky things, have you ever paid your bill in full, but then saw a small interest charge on the next one? It's baffling. That's something called residual interest or trailing interest. It's the interest that was still building up daily between the day your statement was printed and the day your payment actually went through. It's a real gotcha if you're not aware of it. All right, we've figured out how they charge you. But now, when you send them your money, where does it actually go? This is super important, especially if you have different types of balances on one card, like a purchase and a balance transfer. So let's get into the rules of payment. So back in the day, before 2009, it was kind of the Wild West. Card companies could apply your payment however they wanted, which usually meant paying off your lowest interest debt first, leaving the expensive stuff to just sit there and grow. But then the Credit Card Act came along and totally changed the game for us consumers. And here's the rule that really puts power back in your hands. If you only pay the minimum due, well, the bank can still apply that to your lowest rate balance. But the second you pay even $1 over the minimum, they are legally required to apply that extra cash to your highest interest balance first. This is a game changer. It means paying just a little bit extra directly attacks your most expensive debt. Speaking of tools to attack debt, let's talk about one of the most popular ones out there, the 0% APR offer. You see them everywhere, right? They can be an amazing help, but you have to know how to use them the right way. Generally, these offers come in 2 flavors. First, you've got 0% on new purchases. This is perfect if you need to make a big purchase, like, say, a new laptop, and you want to pay it off over a year without any interest. Then you've got 0% on balance transfers. This is where you move high-interest debt from another card over to this new one, giving you breathing room to pay it down without interest piling up. Now, it's really important to remember that interest-free doesn't always mean cost-free. Most balance transfers will hit you with a one-time fee, and it's usually somewhere between 3 to 5% of whatever you transfer. So if you're moving $10,000, you could be looking at a fee of up to $500 right off the bat. And this really gets to the heart of it. A 0% intro offer isn't free money. It's a tool. It's a fantastic way to buy yourself some time and save a ton of cash. But, and this is a big but, it only works if you're disciplined and have a plan to pay it off before that intro period ends.
Okay, we have totally cracked the code on how all this interest stuff works. Now let's put that knowledge into action. It's time to build your personal payoff playbook with some real, concrete strategies to take control.
So beyond balance transfers, you've got a few other heavy hitters in your toolkit. You could look into a debt management program through a credit counseling agency. They can often negotiate your rates down for you. Another option is a debt consolidation loan, where you basically bundle all your debts into one single loan, usually with a much better fixed interest rate. We've talked about all these different strategies and methods, but at the end of the day, the fundamental #1 golden rule to avoid interest is just this. Pay your balance in full and on time every single month. If you do that, you'll never pay a penny of interest on your purchases. It's that simple. So at the end of the day, your credit card is a tool. Nothing more, nothing less. And like any tool, it can be really useful, or it can cause some damage if you don't know how to use it. The real question is, are you in control? Understanding how this all works, well, that's the biggest step you can take to make sure the answer is always yes.